Hello, and welcome to our second webinar in a series that Stearns Financial Group is recording discussing private markets. We appreciate you taking the time to join us and hope you find today's discussion informative. My name is PJ Williams, and I am the Co-Chief Investment Officer and Director of Investment Operations at SFG. I'm joined today by Jake Kelsall. Jake is a principal at StepStone Group working on their infrastructure and real assets investment team. The StepStone Group is a global private markets investment manager with assets under management of over $200 billion and capital responsibility of over $800 billion. Thank you for joining us, Jake.
No, great. Good to see you, PJ. Thank you, everyone, for joining today. It's really exciting to be able to speak to you about private infrastructure, which has really been a rapidly growing asset class and one that we are very excited about the opportunity to talk to you about today.
Thanks, Jake. I really do think this can be very informative for the audience. Today's webinar is going to focus on private infrastructure and asset class that SFG believes has tailwinds and be both part of a conservative or aggressive portfolio. I believe most Americans and many citizens from both developed and developing nations around the world would say that the infrastructure within their country needs improvement. Under President Biden, Congress passed the Infrastructure Investment and Jobs Act, which provides for $550 billion in funding towards infrastructure projects. Without getting into the politics of whether the government can efficiently put this money to work in order to maximize benefit to the public, it is clear that this amount will not be sufficient to fix our existing infrastructure while also funding new projects such as data centers. As a result, private funding will be necessary. We are going to first address what private infrastructure is, then discuss the investment opportunities in the space, and conclude with an outlook for the asset class. Before we start, we want to let our audience know that some SFG clients may hold investments in StepStone funds. The discussion today is going to focus on the private infrastructure asset class, not any specific fund. With that intro, let's get started, Jake. At a high level, what is private infrastructure, and what does the universe of investment opportunities look like?
Yeah, it's really interesting, PJ. So private infrastructure, I think, can mean a lot of different things to different people. The way that we think about it at StepStone is really fundamentally infrastructure is assets that are societally essential. And so as society evolves over time, so too does the definition of infrastructure. But it very much what it comes down to an asset class that is essential to the functioning of society. And what that means is that these are resilient through economic cycles. They are supported by long-term cash flows, typically contracted or regulated, have very low inelastic demand, which means that when we think about investors and their portfolios, it really provides that downside protection, low volatility. And really, I think about it as a part of a portfolio that you don't need to worry about every day. You don't need to wake up and read the news and worry about what's happening in your private infrastructure portfolio. It really is the benefit that it provides a bedrock of downside protection, low volatility, and inflation correlation. From an asset perspective, again, the asset class has certainly broadened over time. I think private infrastructure was historically thought about as roads and airports, maybe power utilities. As society, again, has evolved, so too has that definition of infrastructure now spreading out into things like communications. So as access to the internet is really a societal essentiality, you think about if your internet goes out at home, that is as impactful on your daily life as if your water and power goes out. And so that's where things like fiber optic networks, towers, and now we think about data centers really being essential to society and now falling within the infrastructure framework. We also think about just those traditional infrastructure asset classes, whether it be power generation, so that when you turn your lights on, there is light, water, access to water in your household, and then those traditional transportation assets, airports, ports, and then even operating hospitals or waste treatment facilities. So it really is a very broad asset class, but what we really think about as infrastructure are the investment characteristics, what it adds into people's portfolios. So that's where we come back to downside protection, diversification, low volatility, stable returns and yield over time through economic cycles, and really importantly, inflation correlation and protection for investors' portfolios. So it really is.
I was going to just interject, Jake. If you can just quickly go back to the previous slide, when our investors and even myself are thinking about making investments, let's just use real estate as an example. I understand that I buy the equity in the real estate investment, I own the tangible asset, and I'm going to get a cash flow from that asset. When I'm thinking about toll roads, those make sense. I own the road, and people are going down the road each day, and they're paying me a toll. But can you kind of explain how an investment might be structured for, say, a hospital or an airport? How am I as an investor getting paid? And what am I investing in? Am I buying equity, preferred equity? Am I being a lender as providing debt? How does that work in these investments?
So you can really invest in infrastructure in a multitude of different ways, but you should definitely really think about it as owning the equity in the infrastructure project or asset itself. I think that is the simplest way to think about infrastructure. The way that we get paid in infrastructure typically is going to be some form of long-term contracted cash flow that has limited volatility, is not tied necessarily to the direct number of users. We have minimum volume guarantees. We have contracted frameworks where we are paid potentially the same income every month, day, quarter. And so that's really where we think about where this downside protection and low volatility of the asset class comes from. We have often a government counterparty on the other side, paying a long-term contract where we are earning a consistent income over time. And so where you put all of that together, you own the equity in the asset that is very consistently used over time. You have a 20 to 30-year contract with a government counterparty or an A-rated financial sponsor. And so when we put all of that together, that's really where we think about what forms infrastructure. It's not necessarily is every tower or every airport infrastructure. It is, or every data center infrastructure is probably the more apt example. It really is, doesn't have these factors. Does it have long-term contracted cash flows to be able to provide these characteristics within people's portfolios?
And you just mentioned the government being on the other side of the table, being maybe the payer to us as the equity investor, the owner of the investment, whatever that may be. Right now, with the lack of funding that is the shortfall in funding for infrastructure projects, are we seeing any public-private development projects where the government's actually contributing equity alongside private investors contributing equity?
So there is elements of government funding, but I think what we've increasingly seen over the course of the past several decades is public balance sheets are constrained. Increasingly, governments can't fund these projects. And so that's really where we've seen the growth of the private infrastructure asset class come through, is that it really is only the private sector that can truly fund the trillions of dollars of private infrastructure investment that is required to be able to not just support existing society and existing infrastructure, but build that next generation of infrastructure as we see the significant power requirements in the US, for example, the need for build out from the communications sector, as well as then the revitalization of transport and building out new supply chain and logistics within the US. And so it's really that private market that is supporting this next tailwind of private infrastructure investment. You'll always be working alongside, would typically be working alongside a government counterparty because these are societally essential assets. They touch people's lives every day. And so the government will have some involvement in a project, but won't necessarily be funding it because of those capital constraints.
Now looking at, kind of the right side of this chart and looking at the growth projections for 26 through 29. Obviously, we're sitting in a higher interest rate environment now than we have over the past decade and a half, really. I mean, the 30-year late last week, early this week, hit the highest since June 2007. Do you see that as being a major headwind or slowing development, really, and investment in the space, especially for greenfield opportunities, which we know there are a lot of needs, especially in the electrical side of the world?
Yeah, it's a great question. The benefit of infrastructure as an asset class is inflation correlation. So we are very positively correlated with inflation because of the way that contractual frameworks work for this asset class. Typically, there is direct inflation pass-throughs or some other annual escalation within the contracts, also supported by how essential these assets are, which leads to inelastic demand. So in times where rates are increasing, we also have the benefit of being able to pass that through from an inflation perspective through our contracts and ultimately earn very well in periods of high interest rates. It's actually something that we saw when we looked back on how this asset class has performed in the high interest rate environment over the course of the past 5 years or so. These are assets that have, again, direct inflation pass-throughs, very high EBITDA margins, and typically also long-term fixed rate debt. So what that means is equity owners of this business is that in periods of high inflation, we out earn and can pass that through to investors. So we looked across at StepStone, our utilities, transportation, and renewables assets over the course of 2021 to 2024, when inflation was roughly 5%. And what we saw was that the EBITDA growth of those businesses was in the high teens. And that really reflects that ability to have inelastic demand and pass through inflation. So when the broader macro cycle is facing headwinds, broader portfolios are facing headwinds from inflation and high interest rates, infrastructure really thrives in those periods.
And just for our viewers who may not be familiar with EBITDA, again, it's a measure of earnings. It really means earnings before interest, taxes, depreciation, amortization. And so really what Jake's described on this page is really the earnings growth that we've seen across these various verticals within infrastructure.
So when we look at the history of the asset class, really over the course of the past 15 years or so, what we've really seen is that the infrastructure asset class has provided what we think of as the benefits of the asset class. It is downside protection, low volatility. And what we've seen over the course of the past 15 years or so is roughly 11% annual returns on equity across private infrastructure at a very low level of volatility. So when the listed market is experiencing headwinds, when there is volatility within the broader portfolio, really private infrastructure has provided not just downside protection, but also that ability to earn strong risk-adjusted returns because of the nature of the assets, and really, again, providing what we think is a very attractive added addition within investors' portfolios.
And I think what Jake said there is a main reason that the SFG Investment Committee believes that infrastructure should be a part of most client portfolio or most investor portfolios. And the reason for that is diversification it provides. It is not as correlated as Jake's mentioned with the public market assets that dominate most portfolios, just public bonds and public stocks. And so again, as diversifying play, we think having a portion of your portfolio allocated to infrastructure makes sense.
It's also a really exciting time as an infrastructure investor. I think for the first maybe 10 or so years that the infrastructure asset class really existed coming out of the GFC, as I've spoken many times, this is an asset class that thrives in high inflation environments and we think really provides strong diversification. But for the first 10 or so years that the asset class existed, there really was no inflation. It was also historically thought about as an asset class that was buying assets from the government. You buy assets off a public balance sheet, you own them, you operate them, but it's not necessarily building new infrastructure. Over the course of the past few years, there's been significant shifts in the infrastructure market that has created significant investment opportunities that, as I said, really can only come through from the private sector given the constraints of government balance sheets. And so when we look across transportation, power, data and communications, there really hasn't been a better time from our perspective to be able to enter into the infrastructure asset class, just because of the significant investment that is needed globally, not just in North America, across each of those verticals to both reinvigorate existing aging infrastructure that I think we as individuals see every day. You go through an old airport, you drive on a road that has potholes. The need to reinvigorate that asset and those assets and that part of the infrastructure asset class. but also invest again in what is that next generation of infrastructure, the need to significantly build out in the energy grid within North America and Europe, as well as then significant investment that is required from the data and communication side, not just in data centers, but also when we think about uh, fiber, fiber to the home, fiber to the business, as well as towers, so that you can connect your phone as you move around. So we think it's been a very exciting time in the asset class to be able to earn what we think are these risk adjusted returns.
Is there any concern, from your perspective, that with the AI boom, obviously there's been a lot of money pouring into the space, via data centers and elsewhere to provide more power, chips, whatever it may be. Is there any concern that the market might maybe get ahead of itself in terms of the quantity or the supply of data or power in relation to what the AI needs are, to the point where it might actually suppress returns or be a headwind potentially in the future?
So I think the demand for both power and in terms of energy, as well as compute power on the data center side, I think is very much supporting the valuations of these businesses. The benefit with our approach to investing in those sectors as infrastructure investors is not taking speculative risk. What we invest in is contracted cash flows. And so we invest when there is certainty around the use of energy and the use of compute from a data center perspective. The demand for that power and energy and data center capacity is really supporting very much the valuations of those assets. They are ultimately essential assets that have significant demand today. And so if you own those assets today, or if you as a well-tenured infrastructure investor can develop those assets in the short to medium term, it is extremely valuable because of the very high demand for those assets. So there is always a focus from an infrastructure investment perspective of, to be infrastructure, we need contracted cash flows, we need inelastic demand. And so really that is the focus from us as investors. There's huge, as you said, huge tailwinds and demand today. So we focus in investing in the asset class really on capitalizing and locking in those returns through long-term contracted cash flows, rather than thinking about what the AI cycle may look like in 10 or 15 years' time.
And I think you brought up a good point there that, people may appreciate or they may not, is that fact that as an infrastructure investor, just like with many other asset classes, you can choose kind of how much risk to take. If you're doing a greenfield development project with no tenant on the other side, speculative, you don't know what's going to happen there. But when you're talking about, investing in something that has contracted cash flows over a period of time with a tenant or, payer to you, whether it be the government or some other entity, that's a very different risk profile again than that development work with nobody, no contracted cash flows on the other side, no guarantee that it's going to be used. And so again, just want to make sure that investors understand that there's a wide spectrum of risk here that can be chosen to take as an investor within infrastructure.
Definitely. And I think it's also important to understand this is a very diverse asset class. Despite being newer within private markets portfolios, there's a huge diversification of managers, risk profiles, sector, geography within the infrastructure asset class. When we look at it today, there's roughly 220 funds in market trying to raise almost $700 billion of private infrastructure capital. So this is a huge opportunity set, and also one where you can be highly selective in the assets, the sectors, the region, the geography, and the managers with which you invest. And so that's, again, I think, very exciting as an infrastructure investor, to be able to have this huge market opportunity today that is very dispersed, and you can be highly selective within that to be able to cultivate a portfolio that really we think provides those underlying characteristics of the asset class.
On this page, one that caught my eye is obviously the top right there, funds by geography. I know it's a number, so it might not be reflective, again, of the AUM being raised in these different areas. But I was surprised to see Europe, in line with the North America and well ahead of emerging markets. when you think of China, when you think of other areas that they're making huge capital investments, but it might not be private, and that might be the difference here, is as it's more government focused. But what would you say Europe is focusing on relative to the U.S., or really the investment's very, very similar between the two regions right now?
So that's why it's interesting as infrastructure investors. Every region, country, geography needs its own infrastructure. And so every country within Europe or North America or developing economies needs water, power, access to the internet. These are, again, essential assets that are needed by everyone throughout the world. And so it really creates this very diverse investment opportunity set across all of those different regions. Europe and North America have their own, I'd say, unique characteristics, but fundamentally, the assets that we're investing in are very similar across those regions. It is how do we generate more electricity today than we ever have before? How do we catch up and make our grid resilient so that we can harness and move that energy? How can we capitalize from a financial perspective from the tailwinds that exist from AI and general compute increases? And so the tailwinds that we talk about across infrastructure assets really exist across regions and globally, which again, I think really creates this very unique, diversifying component within investors' portfolios that may be tilted to a particular geography or sector today.
That's great, Jake. Anything else you'd want to close with before you get to the fun slides, the legalese that we're required to show before we wrap this up?
No, I think the big takeaway that I would really like to leave people with is it's just a very exciting time to be accessing the infrastructure asset class for the first time. There has never been more opportunities within the asset class than there exists today and will continue to exist for the next several decades. And it really is a unique diversifier within your portfolios. And so we think it's a very exciting time to be looking at the asset class for the first time and one that we're very excited to be able to talk to you about today.
Well, Jake, really appreciate your time today. If you're an SFG client and have any questions about this webinar or the private infrastructure exposure in your portfolio, please do not hesitate to reach out to your wealth advisor. Also, be on the lookout for an invite to our next webinar in this private market series. Thank you again for joining us today.
Thank you.